Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Gemma Mitchell, author of The Money Reset. How you doing?
I'm doing great, thank you. How are you?
Good. For anyone that's just tuning in for the first time, it's a bit of a running joke here on the Australian Finance Podcast, but Gemma's just come out with her book, The Money Reset, and she's been everywhere. There she is. She's holding it up for people that are watching. She's been everywhere. She's been on Sunrise. You're at the Channel 9 studios or something the other day.
I was. It was on Hope Radio. Yep.
Hope Radio.
Yep.
Yeah, bringing faith back to finance. And you've just been everywhere. So you're in Sydney this week. I don't know how much we can say, but what you were doing was super cool. So what have you been up to?
I'm just living it up here. I'm in my hotel room right now, and out my window I can see the Harbour Bridge. So the hotel is I was a bit scared. I sent you a picture of what it looked like from the outside. It was, it's not great on the outside. Budget Ibis in Darlinghurst. But it's actually really nice inside, and I have an amazing view. So I'm loving it.
Yeah. So you rocked up and you're like, oh gosh, what have I done here? This is a bit frugal.
I'm like, because I do love to pick I do like a hotel stay, but I'm also very, as people know, I don't like parting with money, especially when it's not mine, or, I like to be frugal. So I was frugal this time, but it has paid off.
Right on.
You got to do it for the story anyway. One time I stayed at a hotel and it didn't have bed sheets, and I called down to the reception and was like, "Where are the sheets?" And they're like, "Oh, well, housekeeping's gone. Can we bring you some and you make it yourself?" And I was like, "Okay."
Well, the costs have been frugal, but you obviously save money. And today we've got questions sent in by the crew. Everyone on video, if you're on YouTube, if you're listening on Spotify, on Apple, wherever you get your podcasts, thanks for joining us. In this episode, each week we answer your questions. If you do have a question for the show, you can jump into the podcast player, and there's a link there that says Ask a Question. Just select the Australian Finance Podcast. And we've got questions about like a 19-year-old saving for a home. We've got I'm a single, no parents or kids, currently planning to leave super to my parents. All good questions. So we're going to get to that. But two massive things have happened in government meets finance, meets superannuation, meets HECS debt. All of that happened in 1 week. So your one is more interesting for most people that listen to this show, but then the super one, which I'll talk about in a second, more so for bigger balances and that sort of stuff, I'll tackle in a second. So what's happened with HECS debt?
Yes, HECS debt, now known as help debt, but any of those kind of apprentice loans, all of that type of stuff gets pulled into this. So the ATO has been talking about for a while doing a reduction on balances. So last year or the year before, we saw a bit of an
Cry out.
So indexation went through the roof. It went to 7.1%, I think, and it had always sat around that 3 to 4. So they had adjusted that, and then one of the other things that they were looking at doing is wiping 20% off people's balances. So this week it got announced that that is going to happen. So if you have a help debt, any of those kind of education loans, whatever your balance was on the 1st of June 2025, 20% will be reduced from that, which is great.
Massive.
And that is going to happen before the next indexation applies. So HECS debt or help debt is unlike any other kind of loans that we have. Interest isn't calculated daily. So with your home loan or your personal loan, interest is calculated daily and you're always paying it. But with these types of loans, they just take a snapshot of the balance once a year, and then they apply the interest on that balance. So if you've been chipping away at it, you haven't actually been paying that interest. So what they're going to do is they're going to swipe this 20% off, apply that reduction for you, and then they'll calculate what indexation, which is kind of like the interest that you pay on the remaining balance. Yeah, huge. So they've got a calculator there, and I'll put it in the show notes. But if you have a $20,000, say on 1st of June 2025, you had $20,000 owing, your reduction will be $3,877. $26, and that's going to save you an additional $124 in indexation. But really, nearly $4,000 just got wiped off. Like, so cool.
So for people that don't understand how this exactly works, just to echo what Jem was saying, you don't pay interest on your HECS debt. It just gets adjusted up by inflation. That's what we call indexation. So it's like the index of inflation is pushing it up each year. And I can actually reveal today for everyone that listens to the show, because I've often alluded to this, that I have a shed load of HECS debt. The benefit of having 3 degrees hanging on my wall, not really, I don't even know where they are. I don't even think I have them in my house. But I've got 3 degrees and about 1.5 of other degrees that I never finished. But you can see here on the screen, if you're watching, my HECS debt got to $66,000 in June 2022. And then inflation kicked in. So then it rose to 7%, and I got slugged an additional $3,600. Even though I wasn't studying, it went up. And then 4.7% again the following year. And then you can actually see that my income's increased, and I've made contributions to my HECS debt. And you can see in 1 year I paid off $25,000 of HECS debt. And I only check this every couple of years, but I just logged in, and my HECS debt is now only $32,000, which, Gemma, how much does that mean that I save?
Yes, so you are going to see a reduction of $6,202 to that balance, and that's going to save you an extra $198. So that is huge. Like, you're already absolutely smashing it out. It's going down pretty quick. But yeah, $6,200 for you will be wiped off that.
I'm super stoked about that. I didn't even know. So coming into today, I was like, oh, there we go. It's interesting because the way you pay back your help debt, for everyone that doesn't know, the way you pay it back is once your income reaches a certain level, your employer has to withhold a certain amount of percentage of that extra bit, and it goes to pay off this debt. And so the higher your income, the quicker you'll pay it back. And then once it's paid off, then you've got all this extra income in your bank account every month. So it's actually really good to get it down.
That payment arrangement, because it's on tiers, kind of like our tax system, that can stitch people up though, because some of the time they'll have income from other sources, maybe self-employed, maybe it's a side hustle, investment. So at the end of the year when they do their tax, then they've got a lump sum that they actually owe, kind of like a tax bill, but it's actually their help debt. So yes, it can stuff some people up.
Contractors.
If, you've got some other things going on and work's not taking out the amount for you.
Yeah, because that's the thing. The work's not doing it for you. Your employer's not doing it for you. In other news, at the other end of the spectrum, once you've got a big super balance, there was an absolutely horrible tax kind of thing that was going to be brought in by the government, which was, to be honest, the stupidest thing since sliced bread. And if I bring that up on my screen for people that are watching too, there's a wonderful change here, article written by Meg Heffron. Meg's an absolute wonder of superannuation rules and that sort of stuff. Anyway, so for people that don't know, there was this thing called Division 296. In tax and in finance, we always put division in front of it, like Division 293, Division 296. It doesn't really mean anything to anyone. It's just whatever it means. But we went with this one called 296. And previously, the government had put forth this idea that any superannuation balance of more than $3 million would be taxed, but not unlike your income tax, it would be taxed on the value of the fund. So a good example would be like, imagine if you had your property at home and everyone's sitting there, and then you get from the council, you get like an annual rates notice. Your house has gone from $600,000 to $700,000. You now pay $100,000, like pay that $100,000 in your tax bill. And you'd be like, what? Didn't make any sense. So because
absolutely ridiculous. You don't have that money.
That's it. Yeah. So the government wanted to do that to our super balances, which was just bizarre. And they went on about it for like a year. And then everyone lobbied them, and everyone was like, this is absolutely outrageous. I mean, tax us for sure, but don't do it this way.
And don't tax it on money that we don't actually have. And if it is property, it's only worth what somebody will pay for it. Like,
exactly.
If you can't actually sell it, you've paid tax. Yeah, it was absolutely ridiculous. And this is why people lose confidence in systems like this they're amazing systems, but we lose confidence when stuff like this gets thrown around.
At the time, because everyone's like, oh, $3 million super balance, that's pretty high. But if you're younger and you're listening to this and you've got a good career or something like this, and you're like, oh, actually, no, you're going to pay this tax in the future because they didn't index it. They weren't saying it's going to increase. They were saying, no, it's fixed at $3 million for the rest of humanity.
Forever, yeah. So
what they've now done is they've made a few changes to Division 296. Number one is there's there's a new threshold at 10 million. The government was just trying to find tax revenue, and they were looking at the superannuation system and be like, who are these super rich people with all this money in super? It doesn't make sense. So they've got a $3 million range, and then they've got a $10 million range. If you are at a $3 million range, you're going to be taxed at 15% for anything above that, just on what you kind of earn inside the super fund, like normal. All of us listening to this pay 15% tax on our super while we're accumulating our super, right? But then what the government is effectively saying is that if you've got a really big super balance, even after retirement, it's not tax-free for you anymore. After $3 million, you have to pay 15%, which is still really, really good. Like if you've got 3 million super, you're probably drawing like 150 grand a year anyway in income, tax-free, and then you're only paying 15% on the extra bit. So that's pretty good.
And if you had it in your personal name, you're going to be paying a lot more than that. So it's still a favourable system.
Yeah, and then after 10 mil, so what's the 10 mil threshold? The 10 mil threshold is that if you have $10 million in your super fund, you're going to be paying an extra 10% tax rate on top of the 15. So for that bit that's over that, so 25%, which again is still super reasonable. There's a lot of numbers that get thrown out about people with self-managed super funds and how wealthy they are and all this sort of stuff. Actually, I'll just say the final thing with these two numbers is that they're both indexed to inflation. So by the time a 20-year-old gets to retirement, those numbers will be much higher to allow for people that aren't like super wealthy but still have decent super balances. So that's good news. All in all, that is really good news for kind of everyone. But the other number that I was going to refer to before, and just in mind Drew's notes, is there are numbers like that. The share of funds with over $5 million has grown from 18% of all self-managed super funds to 25% in just 4 years. 42 self-managed superannuation funds have more than $100 million in assets and receive more than $140 million a year in tax breaks. So in my opinion, like if you got 100 million super, that's not what it was designed to do. Like good on you, but it's not what it was designed to do. So you should pay some tax. Like
how do you even get 100 mil in super?
You know what you do, Gem, is you start a self-managed super fund and you just punt all your money into venture capital. And you might like...
Yeah, so it's those assets that have gone absolutely, because I'm thinking contribution caps. It's really, really hard
yeah. How could you, even if you put in 30 grand a year for like the next 500 years, you still wouldn't reach that, right?
Property growth and stuff, I'm like that. Yeah, okay, so venture capital.
So they would go, so imagine like their
own business values, maybe.
Yeah, imagine like a business owner, and instead of the business being opened in your name, it's opened in the super fund's name.
By the super fund, yeah.
And then
and all
sold.
The associated assets and
I saw one crazy one where someone had like 200 million in there, and I was like, how does that even happen? Like, but then, that's not what super was designed for. Super was designed for the average person in Australia to provide for their retirement.
To get ahead, to provide. Yep, absolutely.
Yeah. If you got 100 million,
I think these are positive things. Yeah. I think, I don't think there's anything to be worried about. This wouldn't shake my confidence in the super system at all. I was very worried about tax on unrealized gains, which is absolutely ridiculous and a nightmare. Sometimes things go backwards in value. I think they're massive changes, but I'm going to put in the show notes links to both of those. I'll put that article in as well. So if people want to read up more about how it impacts them, they can do so on that.
Cool. Now we do have questions to get through, Gem. We've got a few here, so we'll try and breeze through them. We've got some wonderful episodes that are coming up, some shorter episodes that are coming up on the Australian Finance Podcast soon. So take note of those, including one that's coming up, 5 thematic ETFs that I'd buy. So that's coming out soon, and you've got a few as well. But for today's purposes, if you do ask a question, we love a funny name, first of all, bring that. But 2, is just remember that anything that we do answer is strictly general in nature. We don't know your needs, goals, or objectives. So we really encourage you to reach out to a financial planner before you act on the information that you hear in a Rask podcast. To be honest, or any podcast, because no one can give you personal financial advice through a podcast or a video or social media. At least they're not allowed to. So reach out to a financial planner if you're confused. If we mention super funds or ETFs and stuff, they have a PDS known as a product disclosure statement. That's the lingo. Go and get that and then read that before you actually invest or do whatever. Especially for super. Don't change super funds. Like a lot of people on social media tell you to change super funds and then you lose your insurance, which you can sometimes never get back. So don't go and do that. The first question, which is a good one. I saw this come through, all of the gear and no idea. They say, hi team. Some companies offer salary sacrificing for shares pre-tax. Do you think the tax benefit outweighs the potential concentration risk of being over-invested in one company? Now, Gem, I did actually ask this of Alex Luck, another financial advisor. I'm curious to know what you think.
Well, it really depends. It depends, right? Because we don't know, like the concentration risk, they might be doing lots of other things outside. If that's your only avenue, I'm still all for this because it's a tax effective way to do it, and you could be doing other things outside that offset this, and you could be diversified in your super, and you could be having this other plan. So I kind of think if it's a strong company, it depends on who you work for, right? But I used to work for CBA. We had an arrangement like this. I think it's a really great way that a lot of people actually get into share investing. But if you're worried about the potential concentration risk, then you need to offset that elsewhere. But I have a great example of this. Had a financial planning discovery call this week where we chat to people about, if financial planning is right for them. Yeah. And they had this exact thing. So they had a share portfolio through work of 550,000 and nothing really else outside. They still had their super and they had a couple of properties, so still diversified. But one of their concerns is, I have so much in this company and it hasn't actually performed that well. And how do I start moving out of it? They had just been kind of going through the motions, getting whatever they could. And now they were thinking, hang on, this is a really significant amount and I probably need to be diversifying this a little bit and looking at an exit strategy.
Yep.
But yeah, it's a great way that people first start learning about shares and getting in the market.
Definitely. So for people that aren't familiar with this idea, if you work for a particular employer, like it's very common in America with big technology companies or Australian employees who work for American companies, or even some of the big ones here, Commonwealth Bank you mentioned, you can actually take part of your wage in shares of the company that you work for. And at first it can kind of seem like, oh, it's $1,000 a year. Is that going to make me rich? But if you work for the company for 20 years and the share price goes up, it can be actually a life-changing amount of money for some people.
Absolutely. So yeah, with CBA, I think we used to get a bonus every year of 1,000 per employer, but then you could do the program where you actually bought more by salary sacrificing. But it absolutely does. Like at one point, CBA share price was nearly at $100. Like it definitely adds up.
Yeah. And then a lot of the times you can get the shares if you're an employee. Sometimes you can get them cheaper if you do the salary sacrificing. So for example, you might be able to get them for 5% less than what the market price is because the company effectively issues you more shares. They don't go and buy them and then give them to you. They issue you more shares. So it's a really good incentive. I just think there are some bad examples, Gem, like people that had their salary, their career invested in something like Enron, which was a massive collapse of a company in the United States, or companies go bust. And so, like you said, it's not a negative, it's actually a positive. Just build wealth another way as well. So
yeah, the fact that this person's aware of that is already amazing. But there are some tax consequences and stuff with this. So you want to know how all of that works, like when they vest and stuff.
Yeah. We did an episode with James O'Reilly for folks that are listening. You can go back in the archives. James O'Reilly, it was employee share schemes. And it's a complicated tax thing, and he has a calculator for people. Like, best to speak to your accountant or financial advisor on that one. But it's, I'll give you the short version of it. When you get given shares in Australia under an employment agreement, you pay tax up front, even though you might not be able to sell the share. So you're paying tax on something that hasn't actually been sold yet, which is a bit of a pain in the butt.
And you don't have the money.
Yeah, exactly.
Yeah.
So you got to fund the tax bill before you can sell the shares, which might be years later. So
it's kind of like that unrealized capital gain thing we just talked about. It's kind of how you can get tripped up with a employee share program,
which is a huge problem for startups in Australia. If you think about it, if you're not working for a wage, like if you're like, okay, I'm going to take a risk in my career, I'm going to go work for this really cool startup. I'm not going to take a wage, and for the next year, I'm just going to get paid in shares. And the ATO's like, hold on a second. No, this is like, these are fully priced shares. Go pay for this. And you're like, dude, they can't afford to employ me. This business is going to go bankrupt if they don't give me shares. And then you're like, oh, well, I'll go bankrupt as well. So that's like a big risk. And it's something very different between Australia and the United States. They don't actually do that over there. Anyway, savvy parents. Parents.
I made up their name. So it says in brackets, Gemma called them this because they had their real name. So I wanted to take it out and call them savvy parents.
Okay, savvy parents said, our 19-year-old is saving for his first home. Is there any advantage in buying an investment property while he's still living at home, but foregoing the first home buyer's grant?
I am all for this.
Okay.
I'm all for thinking about this, okay? Because so often I see people focused on there's free money on the table, there's concessions, there's grants. We're going to do everything we can to get that. And they've overlooked that, yes, it might have cost you more, but you might have been in the market way sooner, in a better area, in a different, so I love that they're considering this, and I think everybody should. It's, yes, you're going to miss out on some stuff, some incentives and things, but if you can do it and get in the market potentially sooner or a better area, why wouldn't you consider that? It doesn't always have to be get everything that's on offer.
Yeah, okay.
Does that make sense?
Yeah, no, that's fine. The thing is, though, when you do this, you may potentially give up the first home buyers grant because if it's in your name as a youngster, so you are effectively a homeowner. So you then can't do the 5% deposit scheme and all these other things that we've talked about on the show. One thing that I've thought about with this question was for parents that want to provide for their kids, one of the ways you may be able to do it, and particularly if they've got a partner and you're not 100% sure what's going on there and whatever, is you may be able to buy it with them or you may be able to buy it in a trust. And the reason why you could buy it in a family trust is because it's owned by the trust, but the child can benefit from it. So I'll give you an example of this. I had a family friend that the son was really, really, really interested in property, but obviously didn't have the money. And the parents had just become debt-free and wanted to provide for their son because they thought, well, he's really interested in this thing. It's actually a pretty healthy thing for a 20-year-old to get involved in, to understand how property works, to understand how finance works. What we'll do is we'll buy the property in a family trust so that we control it, so that if you ever get some dubious partner and they're on the scene that, no, they don't get any of it. It's not his, legally, it's not his, it's the trust's. But then they bought the property together and he was able to receive the profits from the property as they renovated it and did it up over a couple of years. And I thought that was a fantastic opportunity. And obviously you need money to do this, but for him to learn, for him to go through the process and potentially not have tax consequences and not have like the spouse issues or any type of relationship breakdown issues. And it also, funnily enough, protected the parents' interests as well if something happened during that process. So I thought that was a really good way to go about it as a kind of out of the box, left of field type example on maybe how that makes sense for people. Now, there's a question here that I might get to I might just go to the last one first, Gem, which is from Mr. Eager Beaver. Can you explain candlestick trading and whether money can be made with confidence once/if mastered? Let's start with what the heck is candlestick trading? So
I'd literally never heard of this before.
So I can just dust off my old chartered financial analyst textbook here. So I'm going to bring this up for people that are watching. If you've ever seen a picture of the stock market and it kind of looks like there's red and green rectangles, like vertical rectangles on the screen, what it actually is what we call a candlestick chart. Now, the candlestick chart is probably the dumbest thing that finance has ever invented. There's some pretty dumb things, but this would be up there as one of the dumbest things. And so what it actually shows you is green rectangle means it was a positive trading day. Red rectangle means it was a negative trading day. And then there's kind of a line that goes through it, which is like the wick of the thing. And what it means is the wick shows you what the maximum share price that day is at the top and what the minimum share price was that day at the bottom. So this is like putting a lipstick on a pig called stock trading. Stock trading is very, very, very different to stock investing. Stock trading is short-term focused. It's way more based on kind of reading the tea leaves, not actually like what does Commonwealth Bank do. It has nothing to do with what Commonwealth Bank does as a bank. It has everything to do with what has the chart told me today.
Yeah,
so
it's all speculative.
It's all speculation. In my opinion, it's all speculation. And I'm not just taking this from the perspective of like my own bias. It's actually, I read some fantastic studies over the years. Obviously, this is what I do for a career. And one of them was from the University of Massey. So Massey University in New Zealand. And they studied the 5,000 most popular trading signals and found that not one of them led to had any efficacy at all. 5,000 strategies. None of them had any efficacy. So people who shill like trading strategies on YouTube or social media or online, like it's a joke. You're better off just buying shares if you're going to do it that in companies that you believe in and just holding on. And we've got a fantastic podcast coming up on the show with someone who I believe is the world's greatest stock picker, David Gardner, the co-founder of the Motley Fool USA. And David's come out with a new book called Rule Breaker Investing. And in my opinion, that would be so much better for people's outcomes than trying to figure out what the hell a candlestick chart is in finance. Mingling Single wrote, I am a single with no partner or kids, and I'm currently planning to leave my super to my parents and maybe a sibling. Will there be any issues, Gem? You're a super expert.
Absolutely. No, you absolutely can do that. You just need to know the right way to do it. So this is where we probably get the most stunned people. Actually, perfect example. I'm in Sydney yesterday. I did a corporate event for Ladies Finance Club and I talked to these amazing women about super. And I said, did you know you can't leave your super to your siblings or your parents? And everyone was like, because they were in their 20s. They're like, okay, so for superannuation, there is a nomination that you can put on your superannuation that says who it goes to, because superannuation is not in your personal name. It's in a trust. So it doesn't form part of your estate, like your car, your bank account, your home, those types of things. So it's separate to that. So there are only certain people that are eligible under the rules of superannuation to get that from the super fund. And they're like a spouse, de facto counts, children, anyone in an interdependent financial relationship. So they're financially dependent on you, which for most of us, our parents aren't and our siblings aren't. That will be very, very hard to prove. In some cases, absolutely. So people think that they can put their siblings and their parents on there. They can, but it makes it invalid. And you won't know this until you've passed away and the fund then goes to pay it out and goes, oh, hey, this is invalid. So if you want to be really, really sure that it goes to them, you can have a will that says who money goes to, and you can actually get your super fund on that nomination. You say legal representative, which means the super fund will pay it to the estate, which that's the only case that they will, is you're telling the super fund the beneficiary is actually my will, my estate. So there is a way to do it, but it's not straightforward. And the amount of times I see people's statement and it's their parents or their sibling, that is invalid. It's not going to potentially go that way.
So it has to be like a legally interdependent or like financially independent relationship or like kids and that sort of stuff.
Yeah.
The only way to do it would be like properly is to say, send my money from my super if I die to my estate, which is governed by my will. And the will then determines where the money goes from that point. So it's like two steps.
So it's gone into a big bucket now with your house and your savings account and all of that. But yeah, the super won't automatically do that. You've got to tell the super fund to do that. And then you can put your parents or your siblings on there.
Got it. Elon Musk, the Elon Musk wrote in and said, hi team, love the show. My question is, are you better to pay bills when you get them or when they are due? My wife pays the bills and I lose track of what is owing, so I assume we are doing well until the end of the month rolls around. I feel like if they were paid and dealt with when they arrived, I would adjust my spending accordingly, e.g. maybe skip pizza night or those few extra beers. Thoughts? I love this because as a business owner, this is exactly what happens as well. Because like
this happens. This happens in households, in businesses. Yeah, I get it.
It's brutal.
So I'm imagining them having a bit of an argument and this keeps coming up on, we should do it this way, we should do it this way. And they're like, right, we'll get Owen to sort this. Yeah. Okay, so I think the most important thing is whichever way you're doing it, you are both on the same page and you're communicating with it. So it's all about your habits. So I would say just pick one way and just try it. Maybe try it for 3 months or 6 months. And if it doesn't work and you actually have to skip too many beers or pizzas, do it a different way. But my initial thoughts were, if you are living paycheck to paycheck kind of thing, I'd want to pay them as they come in. And just get it done and know that they're done, so you know what's left to spend. But if you are someone who follows a budget, like a system, and I always talk about the system that you have your money is like how you set up your bank account, ideally you know what your expenses are for the year roughly, and each pay you're putting money aside into a bills account. I think that works for most people. So in that case, if you have a fully fledged bills account that's constantly having money topped up and you know what your bills are, which is how I try to manage mine. I put, when bills come in, I set them for the due date to automatically pay them, but the money sits with me as long as possible. That has only started working once I got things working really well and I had this fully fledged bills account that's always got money going into it. But if I didn't have that, I would be paying them as they came up, so I knew that they were gone and knew what I had left.
Like it. So you got that
What do
kind
you
of
think?
cash bucket, and then you can automate around that as much as possible.
Yeah.
I would also say to this, you hit the nail on the head with your first sentence of the answer, which was talk to each other.
You just both need to be on the same page. Yeah.
Yeah. Just communication solves all problems in money and relationships, I find. So just communicate. And that will probably be the biggest thing.
Yeah, and you could try it one way and go, cool, we're going to try it your way. And then if that doesn't work, you could try it the other way. And then you could go, hey, which one, actually, they were both not great. How can we make a hybrid of this?
Yeah, definitely.
So, yeah, but I think there's probably a bigger problem, and it's your overall money management.
Definitely.
If that's, yeah. I think you could make it all smoother.
Yeah, I think, like you said, it's like having that float behind you, which probably relieves some of the anxiety. You could put that in a separate account. You could automate across, direct debits or something like that. There are discounts, as everyone should know that listens to the show. Some of the bills, like your car insurance, your Amazon Prime, your this and the other, you will save big time if you can pay it off annually. So, like if you can pay for a year of Amazon Prime or a year of your car insurance upfront or whatever, like I never opt to pay for a year's worth of anything unless there's a discount.
Yeah. And the goal should be to get to that point. Like initially you might not be able to. Maybe some bills you can like slowly start moving to annual as you put more into this bills account. Like it takes ages for you to be able to shift to these, but you could just start. You could be like, right, our aim is by this time next year is we pay our car insurance in advance. And then the year after that, you're like car insurance and rates maybe. Like you kind of just build on it. You can't change it overnight. It's impossible. And it will be so stressful for you. Just start making some small tweaks and work together, and then
So I've just done a bit of a Google, and I think the next door neighbour's crackdown is actually starting to tell you that the podcast is about to end there, Gem, because something's going on in your.
Can you hear that?
Yeah. So that's
construction
fine.
Started.
Yeah, that's it. Yeah, who knows what they're building? So Amazon Prime is $9.99 a month, or $79 a year. So $9.99 a month is $120 a year, or $79. You save a lot by doing that. And this is just a small thing that you can continuously you can look for these deals. And the way I think about this, and for everyone listening to this, is what is the percentage saving? And would I get that percentage if I was keeping money in the bank? No? I could probably consider paying it off now, assuming all else being equal. It takes time. You can't, obviously, not all of us can do this with car insurance and things that cost a lot of money, but for the most part, that's how I think about it. Now, Jim, I know you've got a busy day in Sydney. We'll probably see you on CNN or on Oprah Winfrey by the end of the week, given the trajectory that you're going. So we really do appreciate you taking the time to join us. And also, there'll be links in the show notes. We've got links to the Division 296 tax. We've got links to the HECS calculator. So if you've got a HECS debt like me, jump in there and rejoice. You could probably go and shout yourself maybe those extra few beers that the person was saying instead of skipping. We'll talk. There's all links in there to get financial advice, get money coaching, all of the good stuff. You can also pick up a copy of Gemma's book, which from memory is called The Money Reset. So great for anyone, any stage of life. If you're just kind of looking to get back on track or you've gone through a big life event, The Money Reset is out now. Get it at Dimmicks, get it at your bookstore, get it online. It's great. So Gem, I know you're kind of avoiding us for the sake of the next door construction. One of the downfalls of being remote for a week, but I really appreciate you taking the time and have a great week.
This is really fun. I'll see you next week.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.